Hello, my name is Tyson Romanick, Senior Portfolio Manager here at Baker Boyer. And today I'm going to talk about the markets and the great run that we've had, especially in the stock market. And because of this, we've had a few clients, maybe getting a little nervous, wondering why we haven't rebalanced out of stocks and into bonds. And normally after a run like we've had, this is something we would seriously consider and probably do. But the reason why we aren't making any changes is because our portfolio is basically still balanced. Our bonds, which doesn't get as much press about, have done an exceptional job this year. So our bonds have seen, low double-digit returns over the last year. And all that means is we're not out of line in our investment strategy. So kind of going back, if you remember to 2022, the year, everybody wants to forget, both stocks and bonds went down together. And many clients felt the urge to exit bonds. So the portfolio managers spent most of 2022 and on into 2023 trying to get clients to exercise patience. We had a good feeling that bonds would eventually, see higher returns. And a lot of that just has to do with we like to call bond math. And all this means is that bonds have a more fixed structure. They're more predictable in what they do. And so we have a lot better insight than stocks on the range of outcomes that they have. So in 2023, stocks started to recover quicker than bonds. And so this also made it hard for people to stick with it. But now bonds are showing meaningful returns. And you have to remember, like I said, bonds are a little bit more predictable in how they move. And so what we saw is rates went up, and that just means that new bonds that were issued had a higher interest rate than the bonds you were holding. And that then, devalued the bonds that you held. But, after a time, those bonds mature, and then you're able to use that money to go out and buy new bonds with higher rates. And so after we made it through that painful time in 2022 and the beginning of 2023, you're getting a lot higher interest rates on your bonds. And now kind of on the other side of that, where if bonds were to, if rates were to fall, then, the value of your bonds would increase. And that's kind of what we're seeing now. So although rates, haven't come down dramatically and the Fed still hasn't lowered rates yet, they have come down a little bit. And that's kind of where we've seen the appreciation on the bond side as well. So kind of looking ahead, what does that mean? Where do we go? And as always, the stock market, as we say, is really hard to predict. Stocks could continue to go up from here, and there's no reason to think they can't. The rally that we've seen has been pretty narrow, beholden to, a handful of names. And there's a lot of data showing that this recovery could broaden out and it could continue on through the year. But if stocks do end up going down from here, we still have a meaningful amount in bonds. And that way, if stocks go down, then we can use those bonds to buy cheaper stock. And that's what we would most likely do in that case. So unlike 2022, rates are a lot higher. And so we think bonds will do a lot better job protecting your portfolio in case there is a downturn. And then additionally, there's taxes. So if we were to sell stocks in taxable accounts, you're most likely to get hit with the IRS bill, which nobody likes. So we have to be more deliberate when we make moves in taxable accounts. So again, we're remaining with our current strategy, and we're confident in its ability, to perform well in any type of different market. So with that, I want to thank you for joining us this month. And again, if you have any questions, please reach out to your Baker Boyer representative. Thank you.